Hello everyone. So in today's video we're going to understand what are debentures and then we'll understand the different types of debentures. So to understand debentures, let us take an example. Let's say Reliance Industries wants to raise 500 crores because it wants to set up a new oil refinery. Now Reliance Industries, in order to raise 500 crores, has multiple options. It could either take a bank loan or it could issue shares. So if Reliance Industries wants to raise money, it could either it could take money via bank loan or it could issue shares and provide ownership to investors. The third mechanism which Reliance Industries could do is that it could issue instruments or securities called debentures and borrow money from several, say, lakhs of investors. So it could issue debentures and borrow money. So debentures are basically instruments, or they are loan instruments which enable companies to borrow money from investors. So the key word out here is that companies use debentures to borrow money from investors and thereby finance the objectives they might have. Now if you talk about the features of debentures, let's take this example a step further. So we know that Reliance Industry wants to borrow 500 crores. Let's say in order to borrow 500 crores, Reliance Industry is issuing debentures which have a face value, that is the issuing price is 10,000 rupees and it's paying an interest of 8% per annum and the tenure is 10 years. So what this debenture is going to do is that any investor who buys this debenture, say a unit for 10,000 rupees, he will be paid 800 rupees every year, and in the 10th year he'll be returned the 10,000 rupees which he is lent. So a feature of debenture is that debentures carry a fixed or a predetermined interest rate. Also, debentures are mechanisms which enable companies to borrow for long term. So if companies want to borrow for long term, they can use debentures, and by long term we mean more than 1 year. So typically if companies want to borrow for medium to long term, which is in the range of 3 to 10 years, they use instruments such as debentures. Now another feature of debenture is that debentures do not provide the holders any ownership rights like shares. So because lenders are not lenders, people who are lending money via debentures are essentially creditors of the company, so they are not considered as owners. So thereby debenture holders have limited rights when it comes to the company. So for example, we know that shareholders have voting rights. However, if you talk about debenture holders, they do not have any voting rights in the company. Now, benefit which debenture holders have over shareholders is that they are given priority when it comes to repayment. So by this we mean that, let's say a company has raised money via debentures and that company becomes bankrupt for any reason. Now if the assets of that company were to get sold so as to pay the different lenders or owners of the company, in that case debenture holders will be paid money before from the assets which are recovered by selling those assets before shareholders are paid. So debenture holders are the ones who are paid before shareholders are paid in case a company's assets are liquidated. Now if you talk about debentures, they can be divided into three categories based on three parameters. So the first parameter is security. So you could have company which issues a debenture and backs that debenture by some asset or collateral of its. So let's say a company is raising 100 crores and provides an equivalent amount of asset as a form of security. So that type of debenture is called a secured debenture. So there is a collateral which is backing the borrowing which the company is undertaking. Now, the benefit of a secured debenture is that in case if the company were to fail on any of the payments, be it interest or principal, then the asset can be sold so as to pay back the secured debenture holder. So there is a lower risk of default or lower risk of failure to recover the money which has been lent in case of secured debentures. However, if you talk in context of unsecured debentures, so the borrower does not provide any form of asset as a form of security or guarantee. So unsecured debentures essentially raise money based on the reputation of the borrower. So any investor who's lending money via unsecured debenture is lending money based on the reputation of the company, and there is no asset which is acting as a guarantee for the money which is lent. So thereby unsecured debentures tend to have a higher risk. So there is a higher risk in the sense that there's a higher risk that the money which is being lent may get lost in case if the company fails to make back the payment, because there is no asset which is backing that money which is being lent. So thereby unsecured debentures typically offer a higher interest rate so as to compensate for the lack of security guarantee which they provide. So that is the first way debentures are categorized, which is, are they backed by any form of asset or security, or they're not backed? And if they backed, they called secured debentures, or otherwise they called as unsecured debentures. The second way to categorize debentures would be based on convertibility. So based on convertibility, you have convertible and non-convertible debentures. So what does the word convertibility out here means? So if you talk about convertible debentures are those debentures which after a certain point of duration can be converted into shares or equity of a company. So anyone who lends money via equity debentures has an option in the future after the tenure of convertible debenture gets over, that if he wishes, he can convert those debentures into shares of the company. So thereby convertible debentures are in a way like a hybrid type of instrument, because like your debt instruments, they provide interest payment on a regular basis, and on maturity they can be converted into equity or shares. So thereby convertible debentures, because they combine features of interest payment and ownership, so thereby they are considered as a type of hybrid instruments. On the other hand, if you talk about non-convertible debentures, so they are like your regular debentures which pay periodic interest payment and then they return back the principal amount of on maturity, and non-convertible debentures thereby on maturity cannot be converted into shares. So basically the ability to convert into shares or not convert into shares is the second criteria or manner based on which debentures can be differentiated. The third way in which debentures can be differentiated is based on the criteria of redemption. So by redemption we mean that can they be redeemed in the future or not. So if you talk about redeemable debentures are your regular debentures which pay interest on a periodic basis and then you get back the principal on maturity. However, if you talk about irredeemable debentures, so these debentures cannot be redeemed. That is, they have no maturity on which the principal is paid. So what irredeemable debentures do is that they offer interest payments annually or whatever is the frequency, but the investor does not get paid back the principal amount. The only situation in which these debentures pay back the principal amount is if the company decides to do so or if the company becomes bankrupt. So these are very rare type of debentures and they are not in general issued by the company. So the key word out here is redeemability, that is, can they in the future return the principal or they cannot. If they can return or if they are returning the principal in the future, then they are called redeemable debentures, and if they do not return back the principal amount in the future, they are called irredeemable debentures. Now your debentures, after they are issued by the company for borrowing money, your debentures are listed on stock exchanges such as the National Stock Exchange and the Bombay Stock Exchange. So any investor who has lent money via debentures, if he wishes, he can sell these debentures before maturity on these stock exchanges. So if a investor wants, he can get back the money he has lent to the company even before maturity by selling these debentures on stock exchanges. That is, these are liquid instruments, that is, they can easily be converted into cash. Now there is a requirement from SEBI that any debenture which is issued to the public must have a rating from credit rating agencies such as CRISIL, ICRA and so on. So what you have is that credit rating agencies rate the debentures which a company wants to issue. So credit rating agencies assign ratings such as AAA, A and so on. And what these ratings do is that they indicate how safe a particular debenture is, so that an investor can accordingly make an informed decision. That is, a debenture which has a AAA rating is least likely to default. So thereby, if an investor is investing in a AAA debenture, there is a very good chance that his money is going to stay protected. On the other hand, the AA debenture rating will have a slightly higher amount of risk. So thereby, because SEBI wants to ensure investor protection, debentures need to be rated by credit rating agencies so that investors can make an informed decision. So correspondingly, the interest rates which debentures offer also depends on the ratings which they have. That is, if a debenture has a lower credit rating, then those debentures in general tend to offer higher interest rate as an incentive for investors to invest in those debentures. So this was the concept of debentures. In the next video, we're going to start with a discussion of bonds. I hope you like this video. If you did like this video, stay tuned and follow the channel for more concepts in regards to UPSC economics. Thank you so much for watching.